the Fed were raising rates and doing the balance sheet runoff. And the market screamed higher all year because the Chinese were stimulating, the Europeans had to stimulate. So it feels like, even if the Fed don't do anything, I still think the Fed cut, but let's assume they don't. Well, that's not a prerequisite for the market to do anything. As you said, as long as rates aren't jacking higher, everything's fine.
Hey guys, welcome to Everyday Finance. Renowned macro investor Raoul Pal believes that a sharp change in global sentiment and liquidity will trigger a huge market rally rather than a decline. According to Pal, despite what many people think, the world might be on the verge of a surprisingly peaceful geopolitical landscape. Investor concerns could be significantly allayed by a ceasefire in Ukraine, a diplomatic breakthrough between the United States, Saudi Arabia, and Iran, and a change in the Chinese economy. Pal thinks that even two of these scenarios would eliminate the main left-tail risks, which are extremely negative occurrences that frequently lead to market sell-offs. When the fear subsides, stocks and cryptocurrency may rise sharply. According to Pal, this would be a narrative-driven melt-up or blow-off top, as opposed to a gradual ascent supported by robust growth or earnings. He believes that the following factors are conducive to such a move: cautious investor positioning, skepticism, and the covert regenerating of liquidity by central banks and financial flows. After the decline, investors may rush back into riskier assets, which could cause markets to rise vertically. Pal suggests that we might be approaching the banana zone, a time of rapid, momentum-driven gains, and compares the current market to the early phases of the post-COVID bull run. Based on psychological and liquidity considerations, Pal forecasts a once-in-a-decade rally for the upcoming 9 months. This has an impact on stocks and cryptocurrency, implying that if the market takes off, those who have been sidelined might be left behind. Be ready, keep yourself updated, and understand that the next action might be quick, euphoric, and emotional, rather than gradual or logical.
What I've done is built that framework of how crypto is just a macro asset. And it took a long time for people to believe that. They thought it's something different, it's something unique. It's a macro asset. So you apply the same things that I've always used, which is liquidity, business cycle, all that stuff, plus a bit of technicals and sentiment. There's no voodoo here. It's pretty straightforward as an asset. It's just more volatile. So it's harder to deal with. But you were right. What I was seeing was like the liquidity indicators like Global M2 had stabilized and started going up. It leads Bitcoin. Bitcoin was following it almost perfectly. So I was starting to look for the bottom. Then I start looking at stuff like, okay, where's sentiment on NASDAQ? Because it's tech stock, same thing. It was in the gutter. Right. Sentiment was the worst I had seen since COVID. And that was across the board, across everything. Even hedge fund long short, everybody was max bearish. And I'm looking at liquidity. It's going up. I'm seeing the market getting fearful over a narrative. And I'm like, well, what is the likely outcome here? Are they going to have 150%, a trillion percent tariffs on China? No, they're going to reach something normal. So you've gone from peak headline fear to things could only be better from here. So for me, it was like a no-brainer of an opportunity, both in tech stocks and in crypto. And so going forwards now, normally speaking, this is the period, my framework is about, them rolling the debt and having to provide liquidity to do so. Mm-hmm. And so what we've got is a lot of forward-looking liquidity coming out of whether it's the weakness of the dollar, whether it's other countries using their balance sheets, a number of different mechanisms. And all of that to me is suggesting that the rest of this year is going to be very strong. And I was kind of thinking the NASDAQ was going to be a V-shaped recovery. And my God, it was a V-shaped recovery. And people are still underweight and short. It's a hell of a setup. So, and I tell you what you'd enjoy is we overlaid the chart of 1997, the Asian crisis, was a short, sharp shock, versus now it's almost identical. The 4 month period leading up to it, 4 or 5 months leading up to it, And that was a V-shaped recovery as well, because everybody was caught off sides because they thought the world was going to end. Liquidity came into the system. It was via the Fed that time cutting rates and all the other central banks, and the market just went up in a straight line for the next 2 years. It feels that way to me, and I think you're right. There is a risk here that we rerun 98, 99 or 99 because you've just taken all the tail risk. Let's assume that Saudi, the US, and Israel do a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine, and let's assume that the Chinese will come to the table, do something reasonable. Those three things happen. We've taken all of the left tail off the table. And people are going to be like, oh, but inflation's going to come back. And they're going to keep saying that for 18 months, which they kept saying as inflation's fall. So I think it is not a small probability that we have a really blow off kind of next 9 months or so. The last Trump cycle in 2017, we had the same thing. The market corrected in the beginning because everyone's fearing tariffs and the same narrative. The Fed were raising rates and doing balance sheet runoff. And the market screamed higher all year because the Chinese were stimulating, the Europeans had to stimulate. So it feels like, even if the Fed don't do anything, I still think the Fed cut, but let's assume they don't. Well, that's not a prerequisite for the market to do anything. As you said, as long as rates aren't jacking higher, everything's fine.
Macro investor Raoul Pal provides a contrarian, upbeat outlook based on macroeconomic data and capital flow analysis, despite the headlines being dominated by inflation risks and geopolitical instability. Like equities, he thinks cryptocurrency should be viewed as an extension of the global risk asset universe, but it is more susceptible to changes in the business cycle, investor sentiment, and liquidity. Global money supply, or M2, has bottomed and started to rise, according to Powell. Bitcoin and other risky assets have historically followed this trend, and the current price action seems to support this. Tech stocks and cryptocurrency sentiment are still pessimistic despite price recovery. The fact that retail traders, hedge funds, and institutional investors missed the rally's first leg makes this a classic contrarian setup, according to Powell. Despite widespread pessimism and light positioning, the market has room for substantial upside as capital flows return to riskier assets. Government debt rolling over, global central bank liquidity injections, and dollar weakness all point to the return of liquidity to subsurface markets. Pal makes a compelling analogy to the post-Asian financial crisis recovery of 1998 to 1999, when unexpected central bank actions and international tensions led to a dramatic, V-shaped market recovery. He believes that today's macro environment is comparable. Global liquidity is improving, central banks are reducing their tightening, and fears are subsiding. This rally is independent of the Federal Reserve lowering interest rates, even though Powell views possible rate cuts as a boost. The lack of tightening and the drop in macro fear are what are driving the rally. Powell thinks that, particularly in U.S. markets, we're just beginning a widespread reallocation back into stocks and cryptocurrency. A long-term uptrend into the following year may begin if macro headwinds subside and capital shifts back to riskier assets. There may be a generational opportunity in stocks and digital assets as momentum increases, and investors who have been sitting on the sidelines rush to get back in.
No, it's real, and I'll tell you why it's real. I've just come back from the Middle East. All of the sovereign wealth funds are now buying. Right, these are the largest pools of capital in the world. We're hearing it out of Saudi, out of Abu Dhabi, out of Qatar, and out of Bahrain. And why that's happening is because the US has become crypto friendly. It's the green light. So the US will get some regulation through. There'll be a bit of a shit show and debating about it and the usual stuff, but they will get some regulation through, which is the clarity that all of the pension funds need. So they're waiting as well. So there is a lot of buying to come from the really big players who've been waiting. Like Goldman has not been able to fully build out its desk, and JP Morgan haven't. They've had crypto for a while, but only for certain types of customers. But they want to build out suites of product, but they've been waiting for regulatory clarity. So, yeah, I think it's a big deal. Actually, I really do. Institutions are still either trying to figure out what this thing is.
Yeah.
Right? I had a conversation with one of the biggest kind of financial asset management firms in the world yesterday, based out of the US, and they're like, they've even got a crypto division, but they're other kind of where they allocate the assets. They're like, we don't know how to deal with this. So they're still trying to figure out what it is.
Yeah.
Like they haven't figured out it's a macro asset. Others have. The sovereign wealth funds obviously are just doing it for diversification of reserves. They're like, it's a technology, it's a diversification of reserves. So if the US is going to do it, we're going to do it. So there's different groups doing different stuff. There is a bunch of people who still don't really want to do the homework on it. They're like, we don't know, it's too volatile for us. But I think usually it's the first mover advantage in this. And, again, it reminds me a lot of back in the day when Goldman rolled out the GSCI index and nobody had commodities in their portfolios, and that team had to go around and sell commodities to everybody. The clients would say, but it's too volatile. And you say, yes, but
right.
part of a diversified portfolio, it's exactly the same thing, right?
That's right.
It's exactly. And also, we were around when the gold ETF started, and it's the same thing. Everyone was like, holy shit, where did this come from? It became a very, very big ETF. It's exactly the same. What people like to do, because there's so many new participants in the industry, they think it's all new and different. When you've been around as long as you and I, you realize nothing is different. We've gone through all of this before. This just happens to be a bigger, faster moving asset, but it's the same as GSCI was. It's the same as the gold ETF was. It's the same as the NASDAQ was when we didn't understand what the fuck it was and why it went up all the time. It's all of these things combined, right? So I came up with something, it was only last month in Global Macro Investor that kind of shocked me, hadn't figured out, is that there is a set of dominoes that happen in markets. Financial conditions lead everything. For financial conditions, we use the dollar, rates, and oil, right? The three big financial conditions thing. What we found is that leads like the ISM and other stuff by about 9 months. And it leads liquidity by about 6 months, something like that. Liquidity is what drives Bitcoin and NASDAQ, and it leads it by 3 months. So global M2, let's say, leads Bitcoin by about 3 months. I found out, I was like, what's going on with gold? I put it against against financial conditions. It reacts in real time to financial conditions.
Wow.
I'm like, holy shit, why didn't I figure this out before?
Of all trading securities, right?
Of all the things, well, because it's a pure currency asset, right? It's the pure thing. And so the moment financial conditions ease, gold moves. And so it's leading everything else, which is, we were kind of thinking, is it leading or is it doing something weird? Is it trying to price in some catastrophic risk? No, it was just pricing in the fall in the dollar, the fall, rates didn't really fall a great deal, but the fall in oil.
Macro investor Raoul Pal forecasts a global financial market shift that is similar to previous cycles, but proceeds more quickly. According to his analysis, institutional banks, US pension funds, and Middle Eastern sovereign wealth funds, the biggest capital allocators in the world, are subtly getting ready to reinvest in stocks and cryptocurrency. The primary reason? These institutions are able to enter the cryptocurrency market on a large scale now that regulations are clear, particularly in the United States. While many people are still dubious, Pal likens the volatility of cryptocurrencies to the early market revolutions of gold ETFs and commodity indexes. Early adopters always had the advantage because they conquered their fear. According to Pal's macro thesis, market direction is determined by financial factors such as interest rates, oil prices, and the dollar. These circumstances cause an asset's response to risk and liquidity. He points out that gold responds instantly as a pure monetary asset, But Bitcoin lags behind global liquidity trends by 3 months. Because of central bank manipulation and government deficits, markets now respond to changes in capital flow and systemic liquidity rather than transient noise. Not a rally for publicity. Real liquidity growth, cautious sentiment, and underexposed portfolios, particularly among retail investors, are the main drivers of this structural shift. Strong risk asset rallies, low risk appetites, and increasing liquidity are uncommon. Institutions are no longer passive, whether this is similar to the crypto bull run in 2017 or the recovery in 1998. It is up to individual investors to decide if they are prepared to ride the next wave while smart money quietly positions itself.